But first, tonight's top story, good news for people with a 401k. Another all-time record high for the broader market today, the S&P 500 hitting an all-time high. Now, while we enjoy the recent gains, it's easy to forget some uneasy realities. For example, it's exactly 3 years since the flash crash, an event that destabilized the market. Since then, nothing has been done to fix the underlying problem, and some say it's gotten worse. So what's an investor to do? With us now, Frank Fantozzi, the president and CEO of Planned Financial Services, and Martin Leclerc, the CIO and portfolio manager at Barrack Yard Advisors. Martin, I'm going to start with you. You're on the set here with me. Talk to me about the markets. You know, certainly we saw the S&P 500 hitting a new high today, but when will they run out of gas?
Good question. It could go for a while, but I guess the best way for us to frame it is with respect to really what's going on, and that is this, the fact that cost of money is phony, and that it's creating these sort of roving bubbles. First, it was gold. Gold peaked out about 18 months ago at 1900. And then, of course, bonds have never been more expensive.
That's right.
Interest rates are very low. And then now what's happening is that investors seeking yield have now migrated towards stocks. So it's bid up.
It's a confusing world. It's a new world. Martin, to you. Or I'm sorry, Frank, to you. Martin just mentioned this idea that bonds may be in a bubble. Are you concerned about them? Which market do you like better, stocks or bonds right now?
Well, compared to the two, we feel stocks offer more opportunity and actually security than the fixed income market. With interest rates being low, I think people are driving to that area to invest, but with interest rates eventually going to rise, I think that on any long-term bond, you're going to expose yourself to interest rate risk.
I think people are really worried about that. Martin, to you, I mentioned the flash crash in the introduction to this segment. Nothing has changed there. Still all the black pools, anything could be happening that individual investors would know nothing about. Does it concern you? What do you tell your clients about this?
Well, it's in everyone's interest for Mr. Market to be healthy at all times, and certainly people who speculate in the markets, who buy things because they've gone up and sell things because they've gone down, traders, it's a real concern for them. But for us, it's not so much of a concern because we first of all look at the cash flow stocks are generating, and liquidity for us is really secondary. If you, but it is a concern, and I think individual investors really have to be aware that you don't want to sell your stocks in a declining market.
We don't have that right now. You don't have to worry about that
Exactly.
problem right now. Frank, to you, I want you to comment on something that Dick Grasso said on our show last week, expressing concerns over the safety and the security of the markets. Listen to this.
The structure of the markets in this country is upside down.
How so?
More than 60% of what happens each day happens in dark pools and in, I call them ponds, that no one can swim in. And that's wrong.
You say we could have a flash crash anytime at all. What do you mean by that? Frank.
Oh, I'm sorry. Well, we don't think that, with the likelihood of a flash crash occurring at any point, I really think investors really need to be more focused on the day-to-day, what's happening in the marketplace and impact on the portfolio. I think much of what happens in the dark pools are really more institution to institution and impact people that are really daily trading and on a technical basis.
Martin, we were talking about this new product out there, getting a lot of ink in the Wall Street Journal today, defined maturity ETFs. Basically, these are bond funds that don't act like funds. They act more like bonds. Is that a welcome addition? Is that something that you have any interest in for your clients?
Well, I really don't, because the 10-year rate is still less than 2%. So, you tie your money up for 2%. I just don't find that as being very attractive.
Okay, let's talk about do-it-yourself investing, DIY investing. A lot of people out there expected during this meltdown that individual investors would decide, hey, I'm going to go get some professional advice. Didn't happen. Take a look at these numbers. The growth in people using advisors, 9%. The growth in people doing their own investing, 10%. We're looking at the years 2008 to 2011. Frank, to you, is this surprising? Do you think people are making the right choice?
Well, obviously, as a professional advisor, we think people should be seeking, professional help. But you're always going to have those that feel that the Home Depot approach is the better way to go. But when you look at professional advisors, their access to information, and the fact that they approach things in an unbiased manner, I think people would benefit from that type of clarity on what's going on in the market, as well as tying that into the financial picture that they're trying to develop for their family.
Martin, I think it speaks to the fact that people are still untrusting of the markets and untrusting of anybody they think is associated with the markets. We just had a survey last week from Bankrate.com that showed that 76% of folks don't want to be invested in stocks, even now after this incredible run-up. How long will it take for that confidence to come back? Do you expect to see that confidence come back?
Well, it kind of drives to the heart of the paradox of investing, and that is that when things seem riskiest, it's when they're the least risk, because price is the most important determinant in future rates of return. So in 2009, after the real estate crash and the crash of 2000, and then the crash again in 2009, 2008, things looked really, really scary, and now things look better because we're back to those levels of 2007. But
well, I got to interrupt you here, Martin, because I think people were focused on prices. They were focused on the prices of the assets that they own, not the market levels. So you looked at what had happened to your house price, you looked at what happened to your 401k, and it was hard to be anything but truly disturbed.
And people are still afraid, and part of the statistic you mentioned earlier drives to the point that advisors tend to do the wrong things at the wrong time as well. And
you're human too.
And it's like any other profession. There's only a certain percentage who are really, really competent. And
You've really got it.
As a profession, we haven't proved our worth to the average person.
Well, you know, some people are good and some people aren't, and it's just like anything else, any other profession. Guys, Frank and Martin, thanks for coming on tonight.